Right, good morning, everybody. Thank you for joining us on certainly a fairly cold day here in Kent. This is the first showcase that we're running this week. For those who don't know me, I'm Chris Sanford. I'm the CEO of CoInvestor, which is a platform for managing alternative assets, specialising in EIS and venture. Now this showcase is scheduled to run for 1 hour, really highlighting some of the brightest and best fund managers that we have on the platform, many of them with some very specialist sector knowledge. All of the fund managers today have live funds on the platform. Each of the fund managers will be doing an 8-minute pitch. And for housekeeping, there is a Q&A function which you'll all be familiar with now in Zoom, and we'll be submitting the questions to the fund managers at the end of the 5 pitches. And if we don't get to your questions, or if you have any more in-depth questions, then please contact any of the team at CoInvestor, and we'll follow up with you directly. So perhaps what I'll do is I'll hand over directly to Fred Soneya at HAATCH Ventures, and he can start with the first pitch of the morning.
Thanks, Chris. Morning all. Pleased to be here with CoInvestor. I'm Fred, co-founder and partner of HAATCH Ventures. We're an EIS fund born out of HAATCH, which we started 7 years ago now. So our background is probably a bit different to most fund managers in that all 4 of us as partners and founders were entrepreneurs, and between us have exited 4 businesses in excess of a couple of $100 million. The largest baby retailer in the UK to Morrison's, a technology platform enabling suppliers to pay to position products on retailer websites, to a US NASDAQ listed a marketing platform, and another tech business into Sainsbury's. So we've been around the block together and had some success, and started investing in companies under the HAATCH brand back in 2013 with our own money. What's really happened over the years is we've developed this brand where we get a lot of deal flow for pre-seed, seed technology deals. Really quite broad now. We started off in B2B SaaS in retail. We've moved across to B2B SaaS in all different verticals, everything from augmented reality to artificial intelligence. We've got some voice applications now. We've got on-demand grocery delivery. The list goes on. A couple of years ago, we launched our EIS fund, HAATCH Ventures, basically to take what we were doing in HAATCH Angel and magnify it a lot more. So now we raise quarterly, so we're a traditional quarterly EIS fund. Our next tranche closes at the end of March for full deployment in this tax year, so that's 2020-21 tax year, and we invest in 4 to 6 companies per quarter. Those companies tend to be, 4 or 5 of those will be new to the HAATCH portfolio, and 1 will typically be a follow-on company within our portfolio. We're focused on early stage checks, so our average size check at the moment is about £350,000. The lowest kind of size check we write is 100,000, largest about £500,000. Tend to be first money into early stage tech businesses, tend to be lead their pre-seed and seed rounds, and then support them raise Series A and beyond from other funds, some of which are on this call today, which is exciting. We look for businesses that we can add value to. So we turn down lots of opportunities that are great companies, but where we feel we can add no value. So we're really focused on working with companies. To be honest, we just get too excited by them. So we could never invest in a company and then spend no time with them. And ultimately, we're investing in companies that disrupt the verticals they're in. So that can be a company like Buy Me within our portfolio, which is like Deliveroo, but for grocers. They've taken on-demand delivery, so enabling you to order goods from grocers in as little as an hour, but using the gig economy, to someone like Poplar, who's just been awarded in the top 30 startups in the UK, which is a London augmented reality startup, enabling brands to create augmented reality experiences, which has absolutely rocketed through COVID due to lockdown, retail being shut, and some really interesting brands there, from Speedo to L'Oreal, creating these incredible AR experiences to engage consumers at home. Of course, numbers have to speak for themselves. So although our EIS fund is only 2 years old now, our personal investments are 7 years old in total under Hatch. We're investing early, so we're targeting 10 times returns because we invest as that first check. We're always investing sub £5 million valuation, and we're looking for businesses that can return £100 million plus valuations. That's our strategy. So we go in early, work very hard with them, help them raise capital, and then ultimately try and create an exit at the back of it. Our first exit achieved 276 times return, so that was a really fantastic company. Only £30,000 a month recurring revenue, but sold into an American listed business for $28 million. So really brought for the IP there, which is what we're focused on. Our portfolio continues to perform really well. And I think what's probably quite unique about us is that we continue to personally invest in the fund. So between us as partners, we own 22% of the fund, and our commitment continues. So over the next 2 to 3 years, as our AUM continues to grow and we continue to grow and close new tranches quarterly, we continue to invest alongside our investors quarterly, which really kind of aligns us with our underlying investors. In addition to that, I guess the other thing I should say is our structure and how we work is very fluid with our investors. So we have some investors who just see EIS as part of their portfolio. They're very happy to receive quarterly updates, and that's it. And then we have investors on the other hand who are very keen to start investing in EIS, don't quite know where to start, maybe don't have deal flow themselves or can't get a seat at the table, but want to support some of the underlying portfolio companies. So what we do there is we connect our investors with the underlying companies to provide support from an extended base. So instead of just us and our core team, you know, some of our investors may have been experts or C-suite or exited entrepreneurs in certain verticals that can support our underlying portfolio. So we really provide the best of both worlds to our investors. You can be completely hands-off, traditional fund management, or you can be a bit more hands-on and get involved in some of the underlying companies. We're primarily an EIS fund. We do a couple of SEIS deals a year, and we always offer that to our investors as well. We also offer a few what we call VIP deals to our investors over the year. So these are deals that don't quite fit our EIS mandate. They may not even be EIS eligible, but they're really interesting companies. So we offer them exclusively to our investor base. These are deals that we're going to invest in personally, maybe an American company or European company that doesn't qualify for EIS or is either a bit too early or a bit too late for our fund, and that provides another opportunity for our investors to get involved. So all around, we're 7 years in to Hatch Group, 2 years into our ventures fund. Our next tranche closes at the end of March for deployment in this tax year, and investors are welcome to invest £10,000 and upwards into Hatch.
Thank you, Fred. You managed to cover quite a lot of ground there, Fred, in under time as well. So that was a very, very good start to the session. So thanks a lot, Fred. Next we have Patrick Bradley of Station 12. So over to you, Patrick.
Thank you, Chris. So I'd just like to welcome you to an introduction to Station 12. We were established in 2014, and we are an advisory and investment business focus across 3 principal areas: sports, entertainment, and knowledge. And when I say knowledge, what I mean is education, learning, and immersive technologies. Despite the fact that I mentioned technologies, we're not a tech investor. We're tech agnostic. What we really are is much more about human behavior and the usage coming off those technologies. What we all know from the pandemic that we are currently living through is that the world has changed, and many sectors have been significantly disrupted by the situation we're currently facing. So, you know, retail, property, leisure, all of those sectors, as we know from the headlines today, are having a pretty rough time. But where we think we have been fortunate is that in our sectors, COVID, to a certain extent, is enhancing the business models, and also we are finding that our companies, our investee companies, are resilient to COVID. Just to give you an example of that, in the learning area, we have a business called InSport, which is a sports education business, providing business education to undergraduates, primarily in the US and the UK, plus execs around the world, who want to enhance their specialist knowledge about sport. It is a disruptor in the sense that it's an online business and it's all about employability. And I'm sure those of you with friends, relations, or children at university will see that actually there is a move away from traditional education models to online. So in sport is very much enhancing its position because, sadly, in many ways of what's happening in COVID. We're also seeing stores closed on the high streets, and one of our businesses, YBuy, delivers one-time use items to customers, deliver and collect on a short-term hire basis. And again, we're seeing that business really doing quite well in these circumstances. One of the fastest renting items are exercise bikes, really for obvious reasons, because the gyms have been closed. We're all sitting in our houses watching Netflix, Amazon Prime, and consuming content like never before. And one of our verticals, entertainment, includes content. And our business, Parade Media, is a distributor of content. Again, they are seeing interest sort of surging as the broadcasters and platforms need to replace their inventories of content, because, as we all know, we are consuming it at a very rapid rate of knots. What we know is that the world will have changed after we come out of COVID, and hopefully when the vaccines start to assist us in that. And we know that people will start going out again. So live events is one of our sectors. We're currently offering within our, well, hoping to offer, as we're working with them right now, is a new event, Outward Bound, led by a very high profile Outward Bound figure for families next year. We think that's really a very exciting opportunity, because once we're able to circulate again, we are going to want to get out there in the fresh air and enjoy live events again. We have a theatre rights business. Theatres, yes, they've been hit very badly through the pandemic, but again, people are going to go back to theatre, and also what they're also going to be doing is taking online theatre content, which is what this particular business will be offering at the same time. And also, just in our sports vertical, we are looking at esports, which is obviously doing very well during the pandemic. Was doing well before, but has been enhanced by the situation we find ourselves in. And also women's sport. That's a growing area of sport and a growing area of interest. So the sectors that we are allocating into, where we are specialists, we've been at this for sort of the last 30 years, in various guises, either operationally or on the investment front. Our sectors are those that I think have been resilient in the pandemic and are coming out of the pandemic with real opportunity. In terms of the fund itself, it's a blend of SEIS and EIS. You can select whether you want to do just SEIS or whether you want to blend it or just do EIS. What we're looking to achieve for you is a blend of risk profiles. So you can select specific named companies in our portfolio. We'll be offering 4 to 6 this year, and you can self-select. So you can self-diversify, or you can take the entire named fund. Some of these are follow-on opportunities. In Sport is one of them, and YBuy is one of them. And we'll be bringing 4 new businesses to the offer as well. And again, we are going to be closing investment by the end of this tax year. So we'll be fully allotting by the end of this tax year. So some of them will be follow-ons, some of them early stage, and some of them later stage EIS, where they're revenue generating and profitable. One thing I would say about the companies that we offer is that they are proprietary opportunities. We work with these companies for sometimes 6 to 9 months before we bring them to the fund. We work with them very closely thereafter, but we're a conservative investor. We will only do 4 to 6 a year, because we think early stage companies, you need to stay close to them and that's what we do. We're a very active manager in that sense. In terms of the team, we've all worked together for a long period of time. We worked in a previous investment fund before Station 12 was established in 2014. So, and as I say, we have a blend of investment and operational backgrounds. And I think probably what does distinguish us is the fact that we are in sectors, sports, entertainment, and learning. They all speak to each other, but they are vast sectors where the UK is a market leader. So we see a very good flow of good British entrepreneurial companies coming up. And we tend to be the investor of choice for them. So just to conclude, I know I've got a couple of minutes, but just to conclude, we're going to be offering you 4 to 6 companies in the space, as I say, to follow on in these key sectors. We will be allotting by the end of the year. All of our businesses will have advanced assurances in place. And we would very much welcome you as an investor. So if you do have specific questions on any of our companies or the sectors we're allocating into, please ask during the Q&A session. Sorry. Thank you.
Thank you, Patrick. Yeah, and again, thanks for keeping on time. So that's appreciated. So next up we have Steve Harris, who's CEO at Committed Capital. He's actually showing up as Glenn Stewart, who's one of his colleagues. But don't let that put you off. I'll hand over direct. So over to you, Steve.
Thank you very much indeed. Good morning and welcome. Thanks so much for taking time out of busy diaries to attend today's session. So we're Committed Capital. I'm Steve Harris, the founder and chief exec of the business since 2004. What do? We invest in high-grade, growth stage technology companies. We always say we're tax enhanced, but we're not tax led. So that means that the quality of the underlying companies is incredibly important in everything we do. So we probably see, I don't know, 600-700 potential transactions a year in growth stage companies. And by growth stage, I mean post $1 million turnover, which is critically important for us because it means we can look through the technologies and see what the uptake is, what the view is of the technology. We can test the tech. We have people who like sitting on software call centers 3 or 4 days and just patterning all the calls. And it's critical for us in de-risking the investment in the technology. Other features of a CC investment would be substantial global markets, which varies a little bit, but we're in MarTech, marketing technology, which we last looked about 360 billion globally. EdTech, of course, is huge. The education sector itself is in trillions, EdTech in hundreds of billions globally. We've got 3 investments in that space. So across the piece, we have technologies aimed at very large, growing tech markets. And we look, first of all, using a technique we call crossing the chasm, to focus on one vertical with the company, make sure the company gets really good traction in that vertical. It might be a geography or it might be a tech vertical. And then we work with them to grow and develop the business beyond that into more of a global, onto more of a global stage. So we, I suppose there are 2 areas that we like to think about very hard. One's what we call search and selection and deals, and the other is custodianship. In terms of search and selection and deals, like others on this call, we have a very detailed methodology for going through all the inbound companies. We winnow them down from 700. We probably do about 12 investments a year, something of that sort. And the team is very corporate finance heavy, meaning we've got people who really understand how deals work in every single respect. And then we're very focused on exit right at the beginning. So that's the first thing. In terms of the second piece, custodianship, We have a range of skills, consulting entrepreneurs, corporate financiers who can help grow and develop the company as we work with them going forward. And in particular, when things are going wrong, not everything in this sector goes right. Occasionally we have problems within investee companies. And at that point, we become very hands-on. There are a number of grooved-in techniques to help companies through, for example, cash flow difficulties. When things are going well, equally, we tighten things up. We're very focused on governance. We like small companies to be run as if they were big companies. And we're also focused on the product market fit and helping companies to get the best possible underlying traction for their products in the markets. So what does all of that mean in terms of track record? We've been around since 2001 in the London market. So I've run the London business since 2004. Many of my colleagues have been with me since 2004, 2005. We've invested a tremendous amount of our own wealth in this business. The current fund is about 60 million sterling. Going back in time, we've invested in 33 EIS companies, done 19 exits, and 2 partial exits, each of which is substantial. So the bulk of our holding has been sold at that point. 21 profitable exits, 1 which had a partial loss of about a third, which is more or less recouped to the extent that people were getting EIS on these deals. About 90 million deployed, and the returns over the piece over the last almost 20 years, 41% IRR and 2.4 times return on cash invested. So for investors, we think that very well grooved in processes means that the transactions are substantially de-risked. Equally, we tend to have quite a lot of companies we're investing in at any one time at the moment. We have, I think, 6 companies open for EIS ordinary share issues. We've done a number of future fund deals, so we've got 3 convertible deals also open. And so for investors coming in to partner with us in this venture, cash can be deployed on a pretty secure basis before the end of the tax year. In terms of what investors can do with us, there tend to be two approaches. One is what we call self-select, so individual investors can look at the transactions as they come up and decide individually which of those investments they find attractive and invest in those. Or I guess our preference would be the portfolio investment, so money invested on a discretionary basis, and then classically invested across 8 to 12 investments. And we keep investors fully informed going forward. So each investor has a portal and has data available 24/7 on each and every one of the portfolio companies. So I think really just by way of a summary, we've been around for a long time, very experienced VC investors, some deep capabilities in terms of helping smaller tech companies grow and develop. And we'd obviously be delighted to talk through CoInvestor with anyone interested in investing with us. Thank you so much.
Thank you, Steve. Thank you for covering quite a lot of ground, and again in time, so thank you very much. So next up we have our friends over at NEWABLE Ventures. Sanjeev, I'll hand over to you for your time.
Thank you very much, Chris. So a bit of background from my side. Prior to joining NEWABLE Ventures, I had started my own business, sold that on, and then went into wealth management, where I specialized in working with entrepreneurs on their wealth planning and understanding what their priorities were from that side. So having that kind of understanding, I specialized in early stage investments as well. So put together a lot of the panels for a national wealth management firm for EIS funds, VCT funds, and BPR. And in 2018, I finished my exec MBA and decided to come over to the dark side. joining the fund management world, especially obviously in EIS. And when I made that decision, I looked at some of the companies that we'd been working with, and NEWABLE was one of the ones that really stuck out to me. I think the key thing here is NEWABLE's history and what it actually provides. So NEWABLE is over 38 years old. It was established during Margaret Thatcher's time, and it's actually currently owned by the 32 boroughs of London. And the reason it was established was to help startups and SMEs in and around London and Greater London. And that's why the boroughs of London clubbed together to form this entity. So they were providing commercial units, office spaces back then for these types of businesses. They then went on to add in advice. So this is looking at how to start up, looking at growing the business, and then internationalization for the businesses. And this is really key because it helps the businesses when they're planning to kind of map out their journey over the next coming years, but also looking at where their growth and getting into new territories. So helping businesses and actually taking them on trade missions into different countries and territories to get them contracts there, establish offices there, and build up their overall kind of market as well. And then the final arm is the finance part. And this is split into two. There's a lending arm, which is really looking at providing businesses that are more your lifestyle businesses, but looking for cash injections for stock or asset purchase. And then what I call the most exciting part, which is the ventures arm that I head up. We look at investing in businesses from seed to pre-Series A stage, and I'll cover this in a little bit more detail shortly. In terms of the actual ventures background and history, we were established over 25 years ago as one of the longest and old-standing angel networks in the UK. So Beauhurst has kind of accredited us with that title, and also as one of the most active angel networks in the UK based on our deal volume and deal value. So the fund has actually grown out of a very strong angel syndicate. So between 2006 and 2015, we had a lot of what we call sidecar funds, which were run by the angel network. So the angels who were making decisions on the fund and also kind of investing in these companies themselves, where they would take lead roles in certain businesses as lead advisors, investor directors, NEDs, etc. In 2015, we started to formalize the fund, and that's where we created an independent investment committee and a bit more of a tighter remit around the fund itself. Since then, we have grown the investment committee, so we now have 6 independent professionals who sit on our committee. And as you can see there, between them, there's over 110 years of experience. And what we've done with the investment committee is really combined the kind of entrepreneurial side and experience with deep fund management and asset management experience as well. So what we're getting here is a combination of what is it that normally people would look at when they are in asset allocations at multi-million pound, billion pound funds, and then combining that with entrepreneurial experience from investing in this part. So you're getting a really good actual combination of entrepreneurial, but still the right processes and decision-making to make these types of investments. In terms of the investment remit, so our full investment strategy is driven by the philosophy that the fourth industrial revolution is kind of now in and something termed by the World Economic Forum in 2016. We're now in this part, the digital revolution has transferred into this. And what we're seeing is the blurring of lines between sectors. So if you look at the digital, physical and biological worlds, a lot of the businesses and technologies that are coming out are actually looking at creating a blur between these two, where their technology is actually applicable in many different verticals, but the technology is working to make labor market a lot more efficient, creating efficiencies overall as to how people live and also how people interact with one another in their daily lives. So this is what we've done, is taken a step back to look at where is technology going and where is innovation, more importantly, going over the coming years, and we're looking 5, 10, 15 years, and what are the businesses that we want to be investing in now to be able to kind of capitalize on those types of opportunities. So that's kind of how our fund remit is come about. And then the key thing in here is where we join the NEWABLE platform and the ventures side of the business. So quite a lot of the time I can just reach over to some of my colleagues and say, actually, we've invested in this business. They're now looking to set up office in the US, or they're looking to go out into explore different territories, throw them over to the advice team. And this is where we are kind of able to be the accelerator plus or the incubator plus, because companies at the time that have come to us, which is seed, post-seed, pre-series A stage, they're looking for the additional support, and it's not just an injection of capital, but the importance of that wider support. And the reason that's really important to them and our investors is we're trying to get them to a point where they have reached certain commercial metrics, being able to grow their overall revenues, but also get to the next stage of investment as well. So really providing the escalation of capital, the support, and the established ecosystem that we often talk about through the NEWABLE platform. In terms of the current fund, we invest in between 6 and 9 companies per subscription. We allow for minimum subscription of £20,000, and we expect to deploy that between 6 and 12 months. Now the variation there is because a lot of times we work with these businesses for many months before we actually deploy the cash into them. And in some cases, we will help those companies get grant funding to get to a certain stage and then deploy the investment into them as well. Our ticket sizes for each company can really vary. And this is because we bring to the table a lot of co-investors as a part of the NEWABLE umbrella. So the NEWABLE Angel Network, the NEWABLE Fund, and our co-investment partners can put anywhere between 150,000 to 1.2 million into each underlying business. Brilliant news for us, which was announced to anyone who saw this in the last week. We have recently just been awarded a £10 million fund from the British Business Investments, which is a subsidiary of the British Business Bank. And this is to invest alongside our EIS fund, which is a national fund investing across companies in the UK that are EIS, but also knowledge intensive. In addition to that, it will also be looking at investing in seed deals on a deal by deal basis so that we can start working with them early on before they come into the fund itself. In terms of a quick summary, we are open at the moment in terms of the fund. We have actually gone into monthly closes. So the next tranche closes 5th of December, thereafter the 5th of every month. And like I said, the portfolio will be between 6 and 9 companies, all of them which will be knowledge intensive. So thank you very much.
Okay, thank you, Sanjeev. Thanks for covering quite a lot of ground there. Okay, so final on the initial presentations is Mr. Reece Chowdry over at RLC Ventures. So Reece, over to you.
Thanks, Chris. Thanks everyone for being here this morning. I know it's a bit cold outside. So I'll keep mine really, really short. So we started RLC Ventures around 5 years ago as a partnership, and the premise of what we invested in is really, really simple, and I would think slightly a little bit different to a lot of the people, particularly in the EIS market, is that we basically back global software companies that are global from the start. So they're all UK based, but they're global in their exposure. So what do I mean by that? So they might have sales in Australia, like one of our companies. They might have a back office in India. But what that does particularly, I think, is gives clients a kind of different mix. And that's based particularly on the team. We speak about 2/3 of the languages of the world between the team. So this is a really, really good way to speak to the world globally. And one thing we really focus on is software. So software is at core of what we do, and in 3 areas, and mainly focused on change. So changing the way we work, changing the way we play, and changing the way we manage money. So those are the 3 areas we work on and have a global approach. As a team, we invested in around 60 businesses over the 4 years, and we've done 3 funds. I think you can see on the screen our track record over those 3 funds. But I think it's always good to give a story with all of these these things because it puts a little bit into context in terms of what we're doing. And one of the stories I'll give is one of the company we invested in last year, which is called LabWorks, which are the largest Alexa gaming company in the world. So they started off, they came to us through one of our incubators that we know. We have a very good relationship and we get around 1,500 deals a year. Again, we typically invest in 10 to 15, a bit of a larger portfolio, and I'll touch a little bit on that later. But LabWorks was really an interesting company because it kind of fit our thesis right from the beginning. It was global from the start, so it had players across all of the globe. It was changing the way people work, people play. So they're playing on a new device in a growing market. Nearly everyone has got an Alexa in their home. And it was growing exceptionally fast, obviously the market, and their games were really good. I recommend you try some of them. One's called True or False if you've got an Alexa game. And so why we like this company is because it opened a huge market to things that people didn't traditionally do. So if you're, for example, elderly or blind, you wouldn't be able to play your new PlayStation 5. And so this was a really good way to change the way people do things. And it's been a really good journey. And around 8 million people play their games now, which is a really good success. I think one of the things to point out is that because we have this global software approach to the world, it means that a lot of our companies have a comparative advantage from the start. So it might be access to talent, access to market, having a low cost base. And that nothing epitomized that more than our recent exit, which is a company on the screen. Betting Metrics was a data analytics firm that we invested in through our funds, both of our funds, first two funds, 2.5 years ago. And actually that business was sold to a company in Sweden, and we were the only investors, and we generated 38 times and returned our first fund fully, which was our 2016 fund. And the reason why that was an interesting company is it epitomized our thesis of having a UK-based global software, and they had operations in Bulgaria. And that business only raised £150,000 of capital before we sold it. So that shows you that this thesis is a little different. It's a little bit more global, but gives clients something a little bit more different. In terms of the team, we're all either from investment background or a founder's background. We invest in every single deal alongside our investors. Usually, if our fund, let's say, does like £100,000 check, we're at least investing 10,000 alongside our fund. So we have at least 10% skin in the game on every single deal. What's important to note is that we have a different mentality in terms of portfolio diversification. We realize that all the EIS products are typically early stage, so we focus on giving clients a bit of a wider portfolio. Typically, our clients get 10 to 15 in our portfolio, and our distribution in terms of deployment is slightly longer. So we usually deploy over around a 12-month period. So sometimes that goes over 2 tax years, sometimes it's 1, depending on when you come in the fund. So I think those are the main things. One of the things that we really pride ourselves on is making sure that we have an impact on wider society. So we have created this initiative called the Venture Pledge. Every time we invest in a company, a founder gets to pick a cause that's close to their heart. And when we sell the company, we can give a percentage of our exit profits as RLC back to causes of our founder's choice. So when we sold Betting Metrics this year, we gave £10,000 to the choice of charity that the entrepreneur picked 2.5 years ago. So that's something that's really important to us. In terms of where we invest, there's 3 areas. Pre-revenue businesses, which we have about 10% allocation in our portfolio to. Early revenue, so typically in early revenue, they're doing around £10,000 a month or about £100,000 a year. I think 50% of our companies are going to that bucket. And they're scaling revenue, which usually is typically over £300,000 a year. They're growing very quickly, and around 30% of our portfolio typically go in there. Our minimum ticket is 25,000 through CoInvestor, and happy to answer any more questions around RLC Ventures. But we've been lucky enough to win some great awards recently because we've tried to do things differently, investing in things that people typically don't invest in, and have this global approach. So happy to answer any more questions. And thanks for having me, Chris.
Okay, no, thank you, Reece. Thank you very much. So we've now heard from the 5 fund managers today. We're getting a few questions coming through. So what I'll do is I'll ask each of you, if you can, to cover off these questions, and perhaps we'll start with you, Fred. So if you haven't covered it, so what's the ticket size? The minimum investment for your fund, and in the selective approach, whether there's any additional fees that the investor may incur, is 2 questions, and the other 2 are what's been your best current investment as well as your best exit, and whether there's what's the impact of COVID been on your business. So there's a few things to cover off there, Fred, but if you could try and cover that off in 60 seconds or so, that'd be remarkable.
I'll do my best. I've forgotten the first question already.
So, minimum. So the minimum size.
Okay, I've got it.
Investment.
Minimum investment from investors through CoInvestor is £10,000. On our selective deals or VIP deals, the fees are the same as our fund, so there's no difference there. In terms of COVID, we invest in digital companies, so I have to say COVID has had a positive effect on our portfolio. I can take a couple of examples. We have Buy Me, which is on-demand grocery delivery. Everybody wants groceries. They've grown 1,000x since the beginning of lockdown. If we look at our entire portfolio, which is 25 odd companies at the moment, we've had not a single person let go and not a single person or employee on furlough. So I think the digital sector has done very well and probably outperformed the majority of other sectors in the UK during COVID. Was that all the questions, Chris?
Yeah, I think that was pretty good. So thank you, Fred. Over to you, Patrick. So what's the minimum investment and your selective approach, if there's any fee changes there? I think your best current investment and the impact of COVID.
Okay, so it's £10,000 minimum. The fees are the same whether you select a single company or come into the 4 to 6. In terms of impact of COVID, just take that first. Really what we're seeing is people are spending more in the sectors that we are operating within. The only subsector that's been impacted is live events, where obviously they haven't been able to operate, but across our portfolio we've had very little impact. If anything, our companies' business models are being enhanced, and this is where people are spending money. And I think in terms of the best investment, I think probably Why Buy. And Why Buy we like because it combines all sorts of things. One is that, you know, if you're living in a flat and you have limited storage space, or you just want to declutter your life, getting one-time use items delivered and collected is just a great way to go, whether that's, as I say, an exercise bike or an ice cream maker or bouncy castle for the kids. But also because it's really getting into the sort of green agenda, because I'm sure many of you have a garage like mine, which is full of stuff that, you know, you've bought and you've never used again. And that is just creating waste. So this is driven by lots of sort of green values, in the sense that we are reducing the amount of waste. All our packaging is recyclable, etc. So I think it's a really exciting opportunity. Why Buy? I've used it a lot. I've had bike racks and car cleaners and all sorts of things delivered. So that's the one I really like. And it's already sort of getting some approaches from national retailers in terms of partnerships with them. So yeah, Why Buy is the one, I think.
All right. Thank you, Patrick. Steve, I wonder if you could cover off those questions that have been coming in. So ticket size, the change of fees and selective approach, your sort of best current investment, and the impact of COVID.
Thank you, Chris. Yeah. So ticket size 15,000 minimum. As regards selective, there are no additional fees there. As a general point, there are no additional fees in our prospectus, if you look at it, I know there are bits and pieces you occasionally see, but you know, we've completely come clean on that. So best investment, actually current, it is just about current. We did an investment in the noughties in a payment system called PSP, which had various incarnations, but it's just going through a sale process with WEX for $1.7 billion. And unfortunately in the travel space, so there's a tiny bit of controversy about it, as you can imagine. But essentially it did what we like to do, which it started off very narrow, really good micro payments system, quite sort of avant-garde in those days, focused on one sector, travel, started off with little local deals with the big global distribution systems companies, and then went global. And I think, you know, travel space probably 80% dominated by Galileo, Sabre, Amadeus, and it had deals with all those. So it's done really well, and we're just concluding that at the moment. We actually signed it in January, subject to regulatory approval. That's that. COVID, I think, in common with others, my other colleagues on this call, the overall impact of COVID, I mean, clearly we're as horrified as anyone, but just purely commercially on the portfolio has been benign, really. And I think what I would do just quickly and anecdotally is to point to one sector, you know, which is EdTech, and I sit on the board of 3 EdTech companies, and 2 of those will double or treble their revenue as a result of COVID. One provides platforms and you know, academic textbooks, course notes into universities in the UK. I mean, they've signed 100 new UK deals with UK, you know, all of university deals. This company, Cortext, through COVID, just extraordinary. There are only 162 universities total in the UK, which gives you an idea of the scope of that. And another one, Bowclips, I'm on the board of, and once again, I just turn up to board meetings and I'm ambushed in the most pleasant way you can imagine, where they sort of say, well, we just closed another $18 million of transactions. You know, and that's provision of film clips, which are curated for curricula, UK, US, globally 2 or 3 million film clips. It's a, you know, a really very good business. So there are others, one or two where they've had a retail route to market where we've had to do lots of work. I think very quickly that the thing to do, what we did back in March, is to say, here's a problem, how do we tackle it? We had a kind of 4-phase approach, which we worked through at the investment committee. Everybody had a hand in, but it's sort of analytical, cost cutting, government support schemes of various sorts, reconnect the product with the market where there are problems, and then finally redo the business plan, recut the cash flows, and invest further money. And we've done that. Goodness, we've done a lot of investing since the beginning of COVID, probably 12 investments rather, in existing portfolio companies, but actually the portfolio is in good shape.
Okay, thank you, Steve. Sanjeev, just to make your life slightly complicated, you got an extra question. Just if you could just reiterate, please. I think you did cover it, but just how much investment is coming from the British Business Bank into NEWABLE Ventures, and then those standard questions that are sort of broad across for everybody, the ticket size. I don't know if you do a selective approach, actually, Sanjeev, but maybe you can.
We do indeed. So that comes into our angel network. So going in order, we have minimum investment of 20,000 into the fund. We have got our own kind of portal that also works quite well with CoInvestor, so people can see exactly what deals are coming up over a period of time, so they can take that approach on the angel side or go into the fund. In terms of our portfolio, best investment is a knowledge graph company, which is really changing the way data is stored and worked with to create better and more efficient relationships with data, and also be able to, in a lot of places, start creating a lot more machine learning that works a lot easier with coding. In terms of exits, over the last 7 exits, we've returned an average of 5.7 times capital. One of the best ones that we had in an exit was a brand watch, and then the most recent one we had was City Pantry that was exited to Just Eat. With regards to the BBI investment, they have approved 15 that have currently committed for 10 million, and over the period of time we will look to increase back over and take that approved amount into our fund.
Okay, thank you. And Reece, last but not least, I hope, wonder if you could cover off the same question. So your investment size, if there's any fee changes on the selective approach, is the best current investment and the impact of COVID. Reece.
Sure. So in terms of the fee side, I mentioned it in my presentation. It's 20. So ticket size is 25,000. I think a lot of people on the call. I was just looking at the Q&A, and I know a few people were asking actually what is the fees to investors on the fund. So ours is very, very simple. It's 1.6% management fee, and it's 20% carry over and above all principal plus management fee returns. So very, 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 very simple structure on that. In terms of COVID, again, as I mentioned, we are global software investors from the outset. We have no exposure. We have no travel tech companies in the portfolio. Obviously global in its approach. So again, we very much been a proponent of. Had benefited from COVID, people playing more games, people using more software across the globe, and so the portfolio has done very well, and on average most of them are growing, and none of them have failed during this period, which is a great result. And in terms of, what was your last question, Chris?
So the impact of COVID, impact of COVID, best current investment.
Oh yeah. And yeah, I think in terms of the best investment, we as I mentioned in my presentation, we just recently sold Betting Metrics. Was obviously a really good exit, which in a short period of time has generated capital in 2 of our funds for our investors, and that was a great result this year in times where it's been a very challenging market for a lot of people. So yeah, I think that sums it up nicely. And if anyone's got any other questions, please hesitate to contact.
Yeah, we've had a number of questions around the fee structures for each of the different funds. I think if I can just take 30 seconds out here. So CoInvestor's been working with the EIS Association. We are about to launch a sort of fee calculator, which will be available on our platform, where we'll be listing the funds and all of their fee structures, so that you can compare in a sort of clear and transparent way. So that's shortly to go live on the platform. But until that is live, I just wonder if we could just spend 30 seconds from each of you on your own individual fee structures for your funds. So Fred, I'll put you in the hot seat and ask you to kick off that, please.
Sure. And just to say, I think the initiative on fees and the calculator, which is launching soon, is fantastic and much needed in the market. Our motto is simple scales, so we charge no annual management fees, we charge no dealing fees, no custody fees, no fees to companies. All we charge from a management perspective is 10% on investment, so that's a one-off fee, and then no further fees to investors or investee companies until we return north of 100% of an investor's investment. We then charge a tiered carry structure, so on anything between 1 and 5x return, as a portfolio, we take 25%, and anything over 5x, we take 30% to really incentivize us to go after north of 5x returns.
Okay, yeah. Patrick, over to you on fees.
So on fees, we take a one-off 2% investor fee, and then we charge a 2% monitoring fee to the underlying investee companies, or a minimum of £10,000. We have a 20% carried interest. But one thing I would just stress on our structure is it's a fund structure. So our carried interest is calculated across all of the investments within the fund. So it comes out on a fund basis.
Okay, thank you, Patrick. Over to you, Steve.
Yeah, it's a 1.5% initial fee charged to investors, and then 2% AMC charged to investors, all of which is paid back at the end out of proceeds from exits. And as I've hopefully shown we're reasonably consistent in terms of the way we return money over a couple of decades to investors, and it's a 20% carried interest. I think the point on the fund is important because clearly, if an investor invests across in the discretionary offering across 8 to 12 investments, then we would hope that they would do well across the whole broad swathe of investment. So in other words, you don't suffer. You invest in one company. If it doesn't go well, you don't suffer one loss. You do well across the piece, which is, I guess, another way of saying that we think portfolio theory in this market works really very, very well, and so which is why we like to do a discretionary offering. If that makes sense.
Yeah. Okay. Thank you, Steve. Sanjeev, I wonder if you could just cover off your fee structure, please.
Yep, absolutely. First of all, to echo what Fred said, NEWABLE is also a part of the fee calculator with CoInvestor, and it is, having been on the other side of the fence where as an advisor looking at this across the market, this will really help create a lot more transparency and make it a lot easier for investors and advisors when looking at EIS funds. In terms of our investments, so we charge either 4% or 2% depending on whether it's coming direct or advised, and then a one-off annual management fee for the first year only of 1%. Thereafter, there's no additional charges to the investor until we get to performance fee. And the performance fee, we return a hurdle of 1.1. Anything above 1.1, we then take 20%. And that's on, like many of the others who have in this on this panel have said, it's across the entire subscription, as that makes it the most fair for our investors, and also ensures that we are working to get the best result from each of our portfolio companies, even though we may have some underlying companies that fail. Overall, we want to be returning, obviously, in terms of subscription, much higher than the initial pound that you've put in. With regards to our companies, the fees can vary there depending on how much we're doing with them in different services, but we tend to cap that at 5%, and that's if they're looking at other services across the NEWABLE platform. In terms of the annual management fee, it is an average of 1.2% for 3 years.
Okay, thank you, Sanjeev. And Reece, I wonder if you could cover off your fee structure again, please.
Yeah, sure. As I said before, it's very, very simple. Charge to investor 1.6% annual management fee, 20% carry over and above, again, as I think everyone nearly said on the call, portfolio return. So i.e. we don't take it on a deal by deal basis. So if we invest £1 in a company and we make £2, we do not take carry. We have to return all of your money first before we take any carry. We try to keep it simple and transparent, and there's no custody in entry. It's just a really simple flat fee, which I think people can understand.
Yeah, I think on behalf of everybody here, I'd like thank you for your participation in the transparency fee calculator that we've all been working on, and say that's going live on the platform. And everybody here's funds and fee structures can currently be viewed on the CoInvestor platform as well. We're just about wrapping up now from a time perspective. So what I'd like to do is thank Fred, Patrick, Steve, Sanjeev and Reece from your respective fund companies. As I say, more details are available on the CoInvestor platform. And if anyone listening has any additional questions or would like to follow up, then please contact any of the team at CoInvestor, and we'll happily walk you through anything and put you in touch with any of the fund managers, or provide more information as you need it. But on behalf of everybody, I'd like to thank you all for your time today. And please take a look at the platform and all of the funds available on it. Okay, thank you all. Thanks for attending.